Hello and welcome to this Elements of Costings practice assessments. Today what we're going to do is an Osborne practice assessment. So practice assessment number 1 for Osborne books, and we'll go through it and we'll see the difference in style between that and the BPP ones. Useful to see that because the examiner can play around with styles in there, and I do find that sometimes either BPP or Osborne becomes a bit samey in the way in which they lay it out. So let's go and do an Osborne one now. So we've got 10 tasks we'll get through. I'll quicken up the pace a bit as well compared to previous ones. We'll see if we can knock this out in about 45 minutes, hopefully. Right, if I can stop waffling. Identify 2 examples of indirect costs from the following list. So, direct costs feels a bit like variable costs, attached specifically to it. We're going to see raw materials, labour costs, something like that. Indirect costs, we're going to see things like overheads, that kind of thing. So, materials used in production, no, definitely not. So that will be a no for the materials. The factory rent is going to be indirect, isn't it? So that's going to be factory rent is going to be one of them. Okay, and the administration expenses as well. That's going to be another one. Expenses. So those are going to be our 2 indirect ones in here. Let's have a look. Piecework payments to production workers. So that's labour specifically attached to the actual production. Even if it was a time rate method to production workers, that's still going to be direct cost because it's specifically attached to making things and what have you. Or then we've got there's the production workers basis wage. So both of those 2 are direct, as in the materials, because that's what we're using to physically create it. These things, these factory rent and administration, they're sort of overheads, fixed costs, feels like that really in there. So that's where we're going for that one. Right, complete the following sentences using the terms form of the options. Analyzing cost by element involves, by element involves 2, 3 or 4 categories of cost. Okay. Analyzing cost by nature involves 2, 3 or 4. So by element we're going to be going in terms of one's going to be direct and one's going to be indirect, and the other one's going to be, so by nature is going to be the 2, and that's direct and indirect costs. So this one here, this one is a by nature cost in here, and this one by element is going to be variable, fixed, and semi-variable. Okay, so that one's going to be 3. So by element is going to be 3 because that's going to be variable, fixed cost, and semi-variable, and by nature is going to be 2 because that's going to be direct and indirect. Nice question, that, a little bit tricky, you have to think. Right, okay, so that one's going to be 3, and that one's going to be 2. Okay, the table below lists some characteristics of financial accounting and management accounting. So financial accounting, the price for having limited liability of a company. Companies are accounting in a very specific way for the outside world to produce your credit checks and what have you. And management accounting, what you're using with your managers to be able to run the business. Right. Indicate law, which one? Right, okay. It records what has happened, so past time, and summarizes information. Feels very financial accounting, that one to me. So we're going to go for probably A for financial. I mean, to be fair, it's probably the same with management accountants, to be honest with you, but I'm going to feel that's more going to be financial one. It looks in great detail at costs and income to provide information for managers. Well, that's going to be management accounting. It is for internal use in the organisation. Right, so that's going to be management accounting, because as I described, financial accounting is for external use, really. It provides financial statements primarily for those outside the organisation. Financial accounting. Right, so those are those 2 there. Right, is that it? Oh, got some more from right, okay. Oliver is a manufacturer of company products. It uses an alpha. So an alpha, which is letters first and then numbers afterwards, coding structure based on 1 profit center and 2 cost centers. Okay, as outlined below. Each cost has a subcode, and then what you've got to have is this little slash in between. Alright, so we're going that. Right, so what we're going to do here is we've got the letters first, and then the little slash, which we need to put in, and then the subcode afterwards. Now, what I would always do in your workings, subcode, is do it like this, and then we'll stick it together. And so, alright, we've got it down here. Okay, what we're up to. So, fabric for making tents. So that's going to be in our production. So our production code is going to be 200. The subcode is going to be then fabric It's going to be materials then, which is going to be A. And so then we're going to stick it together. I will do what I normally do is a little bit of Excel training whilst we're on there. Concatenate that cell, a little slash in between, and then that cell. Okay, so that's how it would look. 200/A. Let's do the next one now. Electricity for offices. So we've got our administration, which was our code, that's for the offices. And our subcode is going to be electricity, so let's have a look. We've got expenses. So it would look like that. Okay. Wages for sewing machinists in the factory. So we've got, we're in the factory, so we're in production, 200. And we've got labour, which is B. And so it would look like that. Sales of sleeping bags. So in sales, 100. And they are, well, it's tents. So that's not sleeping bags, it's other products, which is Y. And so it'll look like that. Cool. Okay. And then the photocopier paper for the offices. So that's administration. Let me just get these to line up a little bit more. Better. Right, so we're administration and we're in photocopying paper, which is going to be expenses because it's not really a material. I mean, actually, to be fair, is it? It's not really event materials. Oh, I'll probably go A for that one. Actually, is it paper? Does it feel like it for administration? Bit of an interesting one, that one. Could have really have gone either way, to be honest. I'm going to go A on that one. Why have I suddenly gone and moved out of line? Okay, and then the salary of the office manager. So the office manager is in administration. That's what one is. An office manager is typically in accountancy speak the person who is not the professional accountant, but sort of runs the finance office, you know, with our clerks underneath. And then the salary of them is going to be labour B, so it'll be 300B. Okay. When's that one? That one's going to be an interesting one. Could go either way, that one really. I'm going to assume it's going to be materials because it's attached to administration and therefore we need boxes of paper going around and what have you. You know, interesting. Right, okay, so that's task 1 done. Let's get on to task 2. Okay, make that a little bit bigger. Okay, identify whether the following statements are true or false by putting a tick in the relevant column. Okay, right, now we've got a stock thing in here, and so in stock, let's just, as we always do with our stock thing, create 3 little trucks. And let's start putting things on these trucks. LIFO cost issues inventories at the most recent purchase price. So in LIFO, in here we've got our items 100, 100, and 100. Okay. LIFO issues this one first. Let's put the prices in there. Let's go 9, 10, and 11. It issues this one first, issues this, so it's at the most recent price. So that one would be true. Okay. FIFO issues inventories at the oldest relevant purchase price. So FIFO issues this one first, then this one, then this one. So that would also be true because that would be the oldest price, wouldn't it? LIFO cost issues inventories at the oldest relevant purchase price. Issues inventory at the oldest relevant purchase price. So LIFO issues this one here, then this one, then this one. So it doesn't issue at the oldest, it issues at the most recent. Let's now get these to line up a little touch. So LIFO, that one's going to be false. See? False. AVCO issues values closing stock at the most recent purchase price. Now, AVCO is average cost is the average of them all in there, so it's average over the whole thing. So it wouldn't be at the most recent purchase price because it's at the average. So that one's going to be false as well. FIFO values closing inventory at the most recent purchase price. So we issue under FIFO this first, then this first. So this would be what we've left over. So our closing inventory will be at the most recent price. So that one would be true. And then LIFO values closing inventory at the most recent price. No, LIFO issues this one first, then this one. So this one's the one that's left over. So that LIFO values closing inventory at the oldest purchase price. So that one would be false. Okay. Now, in terms of sitting there, did I sort of sit down and think and and what have you in there? By simply putting out the three little trucks, three little prices in there, if we might have had something about, you know, rising prices or falling prices, or whatever, which is typically what we would have as a question as well. And by doing that with the three little trucks, we're not thinking anymore. We're making it a lot easier to go through it. So, always do that. As soon as you start to see those, put your little trucks on there and get going. Right, identify the labour payment method by putting the tick in the, so what we're going to have is time rate, we're going to have piecework, we're going to have time rate plus bonuses. Alright, okay, so there we are. Right, labour, so in time rate, it's going to be, everything's going to be just paid per rate, doesn't matter how much you produce. Piecework, no payments per hour work, just going to be everything you produce, and this one's going to be a mixture of both. Right, labour is paid entirely on the output that each individual achieves, that's going to be piecework. Piecework. Labour is paid on an attendance time. Alright, so we've got some time rate going on here. And in addition, an extra amount paid for high productivity. So that's time rate plus bonus. Okay. Ooh, move that back. And labour is paid entirely according to how long each individual works. So regardless of how much they produce, that's going to be time rate. Okay, so those are those three. Identify two uses for a budget from the following list. Calculating variances. Well, that's going to be yes. That, yeah. True. Recording transactions. No. That's going to be false for that one. Maintaining payroll records. False. That's just a daft answer. Identify significant variances. That's a true. And keeping personal records. Personal, that's HR. False. Okay, so it's calculating variances and identifying significant variances. That's the point of a budget. We set out the budget is what's expected, or alternatively it can be what is demanded. It could be that there, because you might set aspirational budgets, even though it'd be a bit annoying. Okay, so task number 3. Company uses a weighted average cost to issue inventories of raw materials. The following record shows raw material movements for there. Complete the inventory records. Cost per kilogram should be completed to pounds to 4 decimal places. Oh, exciting. Okay, we always read our questions, and that's okay, a bit interesting. Right, so we open up now. Always as well. Let's create our our number of trucks according to the thing. So we go in having 2 trucks in, 1 truck out. Right. Starting off with our opening balance, 20,000 in there, and that's cost £160,000. So the price per unit is going to be that. Okay, £8. Then along comes another truck, and it's got 25,000 on top, and it's at £10.70, and it's, just check their addition. Yeah. Okay, so that's that. So that's the position there. Now this is average cost, so we're not doing FIFO or LIFO. We're considering which truck the items are on. We now issue 30,000. So we issue out 30,000 in here. So we need to work out what the values of that is. So the total value of all of the stuff that we have in the warehouse before we issue it is 427,000, and the total units is that 45,000. So the price per unit is that. Okay, £9.50. Right. Interesting to know why I'm not seeing anything yet so far, which is talking about things to 4 decimal places, unless they're just yanking our chain a little bit. Okay, and now we issue this in here, this £30,000. So we're issuing it at £9.50. So the cost per unit would go in here at £9.50. Okay. 50, and the value of that is going to be £285,000. Okay, so the quantity that we've got left in the end, so we're going to now put these now into our table in here, which is going to be our balance, which is what's left. So here now, so we go sort of, let's add these all together. So 20,000 and £160,000. Then we go up, don't we, after this one, and we've got 45,000 for 427500. Then we end up with whatever's left over. It's going to be 15,000. 45,000 minus 30,000, 15,000, and that is going to be 142,500. So that minus that, and that minus that. Okay, so that's that answer there. A bit exciting really with that 4 decimal places, but wasn't really required. Right, complete the following table to show the value of the issue on the 19th of December. So this issue, if we now use different values, okay. And that's the advantage of now, we've got our little trucks, so let's go now starting doing this again. And let's lay out our 3 trucks again. Okay, so we start off, we can just copy this. So we start off with this position there that we still, regardless of whatever method we're using, we'll be at this point in here. Now, under FIFO then, this is the truck that we would take the items off. So we would take, in our 30 items here, 20,000 would come from here, and then 10,000 would come from here. So what we're going to be having then is let's make it even easier. Let's put it on two trucks. 20,000 there, 160,000. And then we'd also take then another 10,000 which we need, and that would come off this one here. So that is going to be that divided by, well actually we've already worked out £10.70 per unit, and so it is that times by £10.70 per unit. So the total value of the FIFO issue is going to be 267,000 for 30,000 units. Now, and what we then do here is we haven't got, that's our total issues, which we've already done before. So our total issues, which we've already done before, added up to 427,000, so total receipts there. So we had 45,000 units in, 427,500 is what they cost. We're now going to deduct off this issue in here. So we take off this amount over here, and so our closing inventory under FIFO is going to be the 427,000 minus the 267,000, 160,500, and the number of units is going to be the 15,000 units that we have left over. Okay, so that would be, so the value of the issue 267,000 for FIFO for 30,000 units, and the amount that's left over 160,500 for 15,000 units. Okay, and let's now do this under LIFO. So we're going to delete out all of this here. Still at the same point beforehand, we're now doing LIFO. So LIFO, we're going to put this on the first truck, 25,000, and it's going to cost us 267,500. And then we've got 5,000 left, so it's 5,000 off this one here. It's going to be £8 per unit, so that one times by 8, and so the value of the issue in this one is 307,500 for the 30,000 units, and the amount that's left over at the end is going to be 120,000 for 15,000 units. Let's now have a little bit of a check of our answer. So we've got 15,000 units here left over. We know that they're £8 a unit, so let's just multiply that £15,000 by £8 per unit. Same figure there, we know that we're right. So there's a little check. That can be helpful. Right, so that is task number 3 done. Let's get into task number 4. Make that a little touch bigger. Okay, Glace Limited pays a time rate. Okay, £9 an hour to its direct labour for a standard 36-hour week. Any labour work working in excess of that paid an overtime rate of £12 an hour. Okay, that's quite nice. Calculate the gross wage. So we're going to have basic, and we're going to have the overtime rate coming in, and okay. Right, so 37 hours and 40 hours. The basic is going to be, we've got 36 hours for each of them, times by £9 an hour. So that's the 324 in both. The overtime then is 1 hour, this first one, isn't it? 37 minus 36, times by the 12, £12 an hour. For the other one, the 40 hours, it's going to be 4 hours, times by 12 hours, And then the gross is going to be those figures added together. So there's our basic, there's our overtime, and there's our gross. Okay. Let's go on to B now. Oliver Limited uses a time rate method with bonus to pay its direct labour. So we've got a time rate method £12 per hour, and they're expected to use £15 per hour. Anything over that, they're paid at 40 pence per unit. Okay, so again, we just create our figures. So we got our basic, and we got our bonus, and our gross. Now, what I like to do in my notes here is almost here, when we're doing the thing, what is probably best to do is put should and did and the difference, because that just makes it easier to calculate the bonus. So actually, in terms of your notes or your workings. So let's now start off in here. 40 hours worked. £12 per hour. So that times by 12. Times by 12. That's what we should have in terms of our basic per hour, our first person. Now, what should they have produced? They should have produced 15 units per hour. So times that by 15. And they actually produced 650. So the difference is 50. We multiply that by 40 pence per unit to give our bonus. And then our gross then is the basic plus the bonus is 500. Now let's go back to this one here. J Davis, 40 hours worked. And we'll do M here while we're there as well. 40 hours worked. Okay. So this person produced 595. Okay, so the difference is minus 5, and it is equal to is minus 5. So we've got minus 5 in there, and the other one produced 580. So they produced less than what we required, so it's just a 0 on both. So they would just be simply paid the basic on these two in here. So they didn't get any money knocked off. You can't go back and sort of go, oh well, it's a minus bonus and whatever, because they've not worked hard enough, and they've just not got a bonus, so those get set to 0. So by putting this, the sort of trick with this question really is it's trying to get you to just dive in. If you put a nice little table yourself there, then what they should do, what they did do, the difference in there, then multiply that difference figure up by the bonus figure. Anything that's minus, it has to be a 0, and then you add it on. That always makes it quite foolproof. So that's question number 4 done. Task 5. Mellis Limited is looking to calculate the unit cost of one of its products, and it needs to calculate an overhead absorption rate. So we can absorb overheads on anything that we decide to do it. You know, in terms of we could do it on the blue socks that we all had on if you wanted to. So, but let's just see what method it's considering. Per machine hour, per labour hour, and per unit. Okay. So you've got these activities here. So you've got some overheads. We're given some things in here. We're now going to see what the activity is. Right. So let's go machine, and we're going to go labour, and we will go units. And this is just a question of just putting it in the actual. Oh, come on, hit the U. There. Right. Okay. So overheads 525,000 in each of them. That. And then we just put in the activity thing. So on the machines we had 66,000 hours, and in labour we had 72,000 hours, and in units we had 100,000 hours. There. So then our absorption rate is just the total unit overheads divided by whatever we decided to pick. So in this one, the machine hours, right now, calculated to 2 decimal places. Okay. So let's put this to 2 decimal places. Okay, 7.95 will be the first one. And then we will go the next one, 7.29, and that's one 5.25. Okay, so that's our opening bit. I think this man, the following data relates to making 1 unit of the product. So we're going to make a unit of this product now. So we've got some figures there, and complete the table below. So 2 decimal places, calculating the total unit cost using 3 overhead rates we've calculated in A. Right, okay, so let's do the same again. So machine, rest material. And so it told us that it cost us 5 litres at £7.50 a litre to create one. 5 times by 7.5. So 37.5 there for each of them. The labour is going to tell us how much we're going to... 20 minutes at £18 an hour. So 18 times by 20 minutes divided by 60 minutes. 6. Or you could have just divided it by 3. Okay, so there's the labour. And then that gives us our direct cost. Okay. Now sometimes you might be given just little boxes without those opening bits. So it might be just calculate direct cost, calculate the total unit cost, something like that. Just these 2 boxes here, and then almost trying to tempt you not to produce this table, but you produce the table because it makes life a lot easier. Right, now then we've got our overheads. And now we're going to absorb them in, and it says we've got 30 minutes of machine time, so that's going to be half of one of those there, but we've got to round that as well again. So there we go, that's half of our overheads. And it's sort of making us do our roundings in there, so we've got these 2 decimal places in going on. Labour, then we've got a labour hours. So let's have a look. We need 20 minutes of time. So it's almost like you're sort of lining them up, aren't you? The labour hours against this labour thing here. So that would be a third of an hour there, though. Divide that by 3. So 2.43. Okay, for that. And then our units is just going to be there. We're producing 1 unit, so it'll be that. Okay. And then our total unit cost then is our direct costs plus this overhead absorption. And there we are. Okay, so there's our answer for task 5. Right, let's do task 6. Identify the type of cost behaviour between fixed, variable and semi-variable described in each statement of the relevant boxes below. Okay. Oh, right, okay, this is quite nice. Right, so what this is we're going to do a high-low method. So we didn't do that in BPP assessment number 2. We did it in number 1, but we didn't see it in 2, which I thought was a bit of a missed opportunity. So we know what we're going to do is we're going to work out high-low method. I'll give you, let's just write this out. So it's fixed costs plus the rate per variable cost, or so let's say the variable cost rate times by the number of units. Right, okay. Ooh, let me just put that. Right, okay. So that's what our thing looks like. Or alternatively, I think if we're doing like an equation, it would be y is equal to m the gradient of the slope times by x plus c the point where it crosses the y-axis, which is the fixed cost. Right, so the maths one's out here. We've got this point number 1, we've got point number 2 here. So we've got the same one here. So what we do is we take one from the other to get rid of the fixed costs, and then we're just given the difference in the variable costs times by the unit. So that's how this works. So what we do is we take number 1, we've got 7,000 units in here, and the cost is 8,400. And we've got number 2, which is 11,500 units, and we've got 13,800. So the difference between the two of them, taking one from the other, 4,000 cost, 4,500 units. In variable cost 5,400. So in this bit here, where we've taken one from that, we've removed the fixed cost from both. So we removed the fixed cost from this bit in the end here, and we got that the variable cost of 4,500 units is 5,400. So that gives us our rate per unit as being, that's the variable cost rate per unit. We then go and multiply this by figure. So what that's telling us actually is that everything looks to be variable costs. So number 1 is all variable cost. There's no fixed cost in number 1, so that one's a variable cost. Let's now do the second one. So we got 4,500 units, and that's 14,000. Assuming that we're missing a 0 in the question, and 7,500 units, and that is 21,800. So again, taking one from the other, 3,000. So we've got some variable costs going on here. Okay, so we've got the variable cost per unit is 2.6. We multiply the 2.6 times by the 4,500. Let's do that, multiply, not plus. Okay, so the fixed cost is 2,300. 2,300 plus 4,500 times by 2.6 is equal to 14,000. And we can do the same here as well to just make sure that the fixed cost is the same, where we've got this right. So let's multiply that, and let's take off that figure from the fixed costs. And you see where our fixed cost is fixed here, and then this is the variable cost at these different rates. Okay, so this one though is a semi-variable, because we've got a bit of fixed and we've got a bit of variable. And then the last one, so we've got 1,400 units, and it costs 10,500, and at 5,250 units, the cost is £2 per unit. Okay, just so we can be a tad awkward. So the same figure, just to make you do a calculation, and we take one from the other, just for completeness, and that's 0. So the variable cost is 0, and it's all fixed cost. So the last one is fixed. Okay. Right, complete the table below by inserting all costs for the activities of 4,000 and 9,500 units. So we've got this table here. We're going to, let's just put our table together. 4,000, 6,000, 8,000, and 950. And the question is trying to tempt you to start dropping numbers in, but we don't do that. We sit down nicely and we do the same thing again. So we've got our 6,000 units in our table, and we've got our £11,000 worth of cost, and we have our 8,000 units, and we have our 13,500 cost there. We deduct one from the other. Okay, to give us that, and then we create our variable cost. Our variable cost is that. Okay, we then work out what our fixed cost is, so we multiply it, so it'll give us our total variable cost. So 6,000 times by 1.25 pounds per unit is that, and that gives us our fixed cost of this, 3,500. And then we'll just make a check our work, because time isn't a factor. We're not really in trouble in terms of time. So we've got £10,000 worth of variable costs of 8,000 units, and so our fixed cost is, we know that our fixed cost is correct. We're now going to go through then, and we've got our variable cost, and we've got our fixed. We know that we can put 3,500 against each of them, and that's going to be the same cost units. And the variable cost then is going to be the units times by the rate per unit. Okay, so 5,000 for 4,000 units, and 7,500 for 6,000 units, 10,000 for 8,000 units, and so on. And then we get our total cost down here, and we add those together. And see how that gives us a little check as well against them. That's how it all works out. A lot of checking going on there and cross-checking, so we definitely know that was the right answer. Okay, let's now do the next one. So task number 7. The company has the following cost information for the last period. Okay, so we've got some cost information for the last period, and inventory information for the start of the period, and we're going to have this one. Oh, right, this is a lovely question. Okay, so let's just get this all on one page, even though it'll be a bit smaller, right? So what this basically is trying to do is it's a manufacturing sort of analysis really here. And what it's trying to do is going to get you to jump and start putting numbers in here with scrabbly questions instead of. Sometimes in the, see, we were in the BPP one, you sort of lined up all these various sort of options or lines in here. So these ones would be all higgledy-piggledy all over the place, and you were to line them up there though, and you put them in a little table, and then you add up the figures you're going along, and it gives you the answers. Here what we've done is we've done very much like the examiner probably would have a bit of a go if they're trying to trick you. Here's some figures over here, here's some figures over here. Start trying to just have a bit of a guess on, or do some individual questions rather than nicely lining it up. So we're not going to do that. We're not going to fall for that trick. Instead what we're going to do is we're going to set out our manufacturing statement. So we have our opening raw materials. Let's find that one. Opening raw materials 5,000. And we're going to put in our purchases over here, and we've got our purchases of 28,000, and we'll have our closing raw materials, over here, 9,000. And so we've got our direct materials used, which is going to be the opening materials plus our purchases minus the materials that we got left. So that's the amount of materials we've used in the period, £24,000 worth of it. And then we're going to put in our direct labour. And that's 37,000. And that's going to give us our direct cost. Oh, that plus that. Now you can see what's happening here so far is that really the temptation is to try and start working out these individually without realizing you're sort of ticking these all off and making sure that they're in the right place. Will you get a mistake? Will you get something wrong and line it up incorrectly, or just get a bit confused or whatever, try and have a bit of a guess and a bit of a mess? We're not going to do that because that would be stupid. And then we're going to have some manufacturing overheads. Overheads. It's going to be in there somewhere. Let's have a look. Let's try and find it. We're going to go indirect labour, probably. Are we? This is an interesting one. We're just going to drop this one in new here. So let's have a look. We're going to go indirect labour, and we've got manufacturing expenses. We'll go indirect labour as well. It's quite nice that we've got a new one going in. But you didn't see indirect labour in the BPP one, so let's put manufacturing overheads and indirect labour in. So manufacturing at 25,000 and the indirect labour at 10,000. Okay, and that's going to get us to that one there. And oh, we've got indirect materials as well. Oh, this is quite nice. And we've got indirect materials as well of 6,000. Okay, and that's going to get us to our manufacturing cost. Oh, and there we go. Manufacturing cost being asked for as the next one. Of 100,000. That's got us to the now we're going to probably we're going to try and get to right. Okay, so what we've now got to do then, so that's going to go to our manufacturing cost. Now what we're going to do then next is we've got to go and have our opening work in progress. And our closing work in progress. So we're going to have opening work in progress 13,000 and closing work in progress 10,000, and that's going to give us the cost of goods manufactured. So this is the cost of the goods manufactured. So if we get to here we've got our direct costs that we've incurred. Or we've got to in this one by all of our direct labour. So that's what we effectively spent on our direct costs. We then got these other additional costs that gets down to our manufacturing costs. So this is amount spent. But now we're going to have the cost of the goods that came off the manufacturing floor and were put back into the warehouse. So we have this opening work in progress that we had, bits of expenses of last period. And we're going to take off that closing work in progress to get to this, which will be the cost of goods manufactured that we sent off the manufacturing floor and we put into the warehouse. You almost have to imagine things coming in. So this is like our materials coming in off trucks, these labour people walking into our factory floor in there. Then we apply these costs of other things that are going on to get this manufacturing cost. Now we've got these bits of steel and what have you, and bits of time that labour that people have left lurking around on the manufacturing floor. Here, though, this was what started and came over from the last period. This is what's left at the end of this period to get to the cost of goods manufactured, and that was actually, this is now sent out of the factory floor and goes back into the warehouse. Then we've got our opening finished and our closing finished. So opening finished 20,000, and we've got 25,000 left at the end. So our cost of actual sales, the things that came out of our warehouse and went off to customers, is going to be 98,000. So that'll be cost of sales. Quite like the introduction of direct labour and indirect labour and indirect materials, which we didn't see in the BPP assessments. Okay, and is that it? That's it for task 7. Okay, task 8. Right, company uses weighted average cost to value raw materials of production. Following record shows raw material movements. Complete the inventory record. In there, again, it's tempting us to try and sort of complete it, but we don't. We never do that with stock. We start to put little trucks in there. So we got the opening one. We've got a receipt coming in. We've got an issue. Right. Okay. Fine. Let's have 3 little trucks. The opening stuff in the warehouse, which we open, put on 1 truck, 80,000. And that's £4 a unit, isn't it? Divided by £4 a unit. Then we got this issue that comes in, £25,000 on this truck, because we'll have later on. Well, we don't have later on. It would have been nice later on to have another question that would have, let's say, been talking about LIFO or FIFO or whatever. Well, we got 25,000 in terms of our items, and that was 10,4,500. And we'll do the price per item. Price per item, £4.18. Right. Then we've got an issue, and we're under average cost. So our balance here, anyway, let's do the first balance. So the first line would be 45,000 units and 184500. So that's the first bit that we're going to those figures there. Okay, and then the next bit, then we've got our average cost. So we now have to work out what price per unit in here. So for that 184,500, those 45,000 units, the average price is £4.10, and so that's what we actually use when we issue out on this truck. 40,000 items go on that truck, and they go on at £4.10. 164,000. So that's what's going to go out. So then we take, let's move this up so it's nice, is it? We're going to take that minus that. So the balance left is going to be 20,500 in terms of value for 5,000 items. And we can do a little check here and just check that our 5,000 items times by the £4.10 is 20,500, and that's right. And so there we've done both in terms of just deducting one from the other and then multiplying at the end. So and we still get the same figure, this £20,500. So we know we're right. Always useful to get a check in there if you can do. Right, complete the following table to show cost for actual November production of 80,000 units of K25 using raw materials calculating part A. All right, okay. So they're using the raw materials issue. So this is the issue from the stock thing. So this issue is actually then done at it's this issue at the £4.10 is 164,000. So what we're going to do then is 80,000 here, and the cost that would apply if the November production had been 86,000. We have to go back and recalculate. Well, okay, great, marvelous. Right, direct materials. So we've got direct materials, 164,000 there. Direct labour, 37,000. Manufacturing overheads of 35,000. Total cost. Okay. And and what that's for 80,000 production. So the cost per unit would be that figure there divided by 80,000. Okay, and we're to show it to. You also want to look at how many decimal places it wants us to look, because that's what it will put in. Cost there though. Okay, cost applied there. Oh, to 3 decimal places here. So we'll do that to 3 decimal places. So there should be another 0 on the end of it. Bit pointless, but there we are. All right, 2.950. Right. Now let's do 86,000. Okay. So the direct materials now. If we went back up here and let's now do this here. So it would be on this truck here. We would have to produce 86,000 units. So we have to use 45,000 for 80,000 units. So we would need 86,000. So 45,000 times by 86,000 divided by 800,000 would be the number of units that we would have to sort of send out or issue. So 48375, and we multiply that up by our £4.10. So that would be the cost. It's not right, is it? Cost of right is number of production would have been 80,000 here. So what have we got? We sent out 45,000 units. Let's do that. You can do this in 2 ways. Let's just make sure that it adds up in the same way. So we times by 86 divided by 80. Right, okay. And let's do the same thing up here, which would be, oh, it's 40,000, wasn't it? Sorry, 40,000 equals 40,000 units times by 86 divided by 80. So 43,000 units, and then that times by £4.10, 176,000, same figure, which it should do, but it's just useful to have a check. There. The direct labour then would be multiplied up again. It would take longer, so we're going to multiply that by 86,000 and divide it by 80,000, or 86 and divide by 80, and that's going to be our labour costs, because these are our variable costs in here, so they're going to vary. The manufacturing overhead is going to stay the same, because we're going to say that's a fixed cost. Yeah, so that's our nature. That gives us our total costs as being that figure, and then we divide this not by 80,000, which is there, but by 86,000. There. And so that would be task 8. Important though in task 8 really was to not be messy, and that ability to have these things on these trucks and go through and be quite neat about it was your working should look like this rather than scrabbly little sort of formulas going left to right. The manager of Prefaces Limited requires a performance report detailing budgeted data, actual data, and variances for last month. Okay, so we go budget actual for a start, and then see where we're going. Right. Okay. So here's our budget here. All right. So we've got budget data. We've got some variances, and I'm going to put little extra tables in, and we'll talk about variances as we're going on. Right. So budget figure, sales. The sales figure was 15,600 times by 52. Okay. The actual figure was 849,350. Okay. So the variance is the difference between the bigger and the smaller number. Yeah. It's a bit annoying. In AAT land, it's the difference between the bigger and the smaller number. And then we say, right, okay, let's go through this one. We've sold more than we thought we would budget for. So that is good. So a good variance is that's positive. Which is, in AAT speak, favourable. Okay. Then we'll do the materials one, so that's sales. Then let's do the materials. So the budget was 8,450 times by £35 per metre. Okay. The actual was 34720. So in AAT land, we take the bigger from the small, take the smaller from the bigger number. Okay, so it's 8970. Okay, and then that will be bad because we spent more than we wanted to do, so it's bad. So that would be negative in the real world, but in AAT land is adverse. Okay, so that's how that would look. So we would take those ones out and there. So that's where we are for that one. And then let's get on to the next one, which is labour. And we have 12,500 hours times by £17.50 an hour is what we budgeted. We actually spent 222,110. Okay, so again in AAT land, we take the smaller from the bigger number, like that. Now we spent more than we actually when we wanted to, so that's bad. We spent more as an expense, and there though, so that will be negative in the real world and adverse in AAT land. And overheads, the budgeted figure is 123,000. The actual figure was 108,000. We take the smaller from the bigger number when we spent less than we wanted to budget, so that's good. So we spent less in reality than the budget, so that would be positive, and in AAT land that's called favourable. Now why do I say AAT land versus what must be the other thing, which would be real world? In the real world, we would actually have this as being just positives and pluses and minuses. So we received more money than we budgeted for, so that we positively look like that. We spent more money than we actually wanted to spend, so it would look like that, a minus figure, a negative like that, and then they would all add up at the bottom where we had our profit, and it would go like this in reality. And so we've got our difference. We'll just go through our equals that minus that minus that minus that. Okay. And that gives us our. So there we go. We've got our profit, our sort of plus figure here, our overall position, and we've got this pluses and minuses. And that's how the rest of the world would have it, because you wouldn't have this favourable and adverse having to be in there, and you wouldn't have this slightly confusing thing. The reason why that's done in reality, in real life, is because remember, when you're doing it and you're actually having a discussion with this, you're actually challenging a manager, and you're challenging them about their performance quite often. So we're going to the say at the buyer, let's say, why are we spending so much on materials, or the production manager, why have you wasted so much on materials? Why have we got this adverse variance in here? The same person on the labour on the shop front, or the sort of the overseer, supervisor. Why have we got such a high level of sickness, let's say, in labour in here? And let's look at the cost that it's incurring us. So you'd have this little minus in here and what have you, so we can just quickly look through and see it. Now let's go into AAT land and see how it looks in here. And in AAT land it looks like this. Yeah, so that's how you're going to have to put it in the exam. Yeah, so in the exam you're going to have to look like that. Now we take the bigger from the smaller number and we put this word next to it. Now the problem is in real life you're then sort of faffing around and messing around for the first sort of 5 or 10 minutes with the manager that's squirming on the hook really for these adverse variances, going, what you on about? Adverse? What do you mean? Is what does adverse mean? Is that good? Is that bad? Or I don't know. Is this a plus figures? Plus figures are good, aren't they? I'm doing really well. And so you spend the first 5 to 10 minutes of any kind of conversation that you're having to have faffing around trying to work out what this is on about, rather than actually getting to the point of, which everyone understands, a minus being a bad figure. So that's why in reality it will not look like this, but we are in the exam. We have to do the exam thing there, so we're going to take the bigger from the small number and then we're going to decide it. The way in which you're going to get to that is, let's delete one out because you can't use that in the exam. You will just go, right, I sold more than I should have done, that's good, that's positive, so positives are favourable. I spent more than I had to do or I wanted to do, That's bad because we got we make don't make as much money. That's negative. That's adverse, and that's the thought process to go through in there. It's a bit annoying. It's not really how it's done in practice. Some people might say, yes, I do that in practice. You have to remember that this is a conversation between, if you're doing it in this way, this is a conversation between one accountant to another accountant, and both of them understanding the situation and the rules of the game. In reality, your conversations on variances are between the accountant, the professional accountant, and the non-accountant manager that you're trying to hold to account, or alternatively saying you're doing a really good job there. And so any barrier that you're putting away in the way of there is not good practice there, and so then this whole sort of wordy messing around is not great. So I'm sure that some people do use it, but that's only because they've been taught it, not necessarily because they've thought their way through it. Right, so a number of statements about budgeting are set out in the table below. Identify whether the following statements are true or false. Okay, if budgeted sales are 1,500 at £1. Alright, okay, so what we're trying to do here is a little trick, trying to get us to think in our heads. Should we ever think in our heads? No, we shouldn't. We should put a little table there though. We've got a budget and we've got some actual, and let's just put the figures in. So we got budgeted figures 15,000 times by 1.8, and the actual sales are 28,500. So we've done more than we sold more than we hoped. That's good. That's positive then. And so that would be, in AAT speak, favourable. Sales variance is favourable. Yay, true. Okay. If the budgeted labour costs are 2,000, so the budget is 2,000 times by £18.50. It's that. And the actual labour costs are 41,000. Okay, well that's bad because we've spent more than we wanted to do, so that would be negative. And you would all recognise that. And so that would be in A speak adverse. Right, labour cost variance is favourable, so that would be false. Okay. When variance is shown as percentages, the percentage is calculated based on the budgeted figures. Right, so this is trying to work out some kind of significance here with a little bit of it. And so basically we would say here, let's go now, let's take these figures here as our variance. That's our variance, and then let's put a percentage. So the variance is the difference between the bigger and the smaller number. Okay, and we will then divide that, and for the significance we divide it always by the budgeted figure. So that would be what it would look like, and with a, let's format that to being a percentage. Okay, so there's our percentage. When variance is shown as a percentage, the percentage is calculated based on the budgeted figures. Yes, that would be true. That's what I just did. Cost variances are favourable when the actual figure exceeds the budgeted figure. No. Right, so let's go through here. Let's do this again. So the actual figure, the actual cost exceeds the budgeted figure. So we spent more than we wanted to. That's bad. So that would be negative, which would be adverse. And they're saying that's favourable, so that would be false. Okay. Now time isn't a factor in this, so we just sort of spent our time and went through and did it in a long-winded way, but it made sure that we were always accurate and we didn't make any kind of mistake. The question really here is desperately trying to get you to make a shortcut and start thinking rather than just laying them out on the table. Right, okay, let's just check if we've got any more of, nope, no more of task 9. Right, task number 10. The managers of Extanta Limited require a budget report for last month to be completed. In particular, they want production cost variances. Alright, so we've got variances. So we've got some actual costs, we've got some budgets in here. We're going to have some variances in here. We're not going to have, again, this always seems to be a little bit in terms of this AAT question as well. We seem to be very sloppy and not put, if we're going to have this variance, we're not going to have the narrative where it's favourable or positive. And that's because this question keeps shortcutting essentially. In real life, as I explained it, would have just the pluses and minuses and wouldn't have the wording in there. But it seems a bit weird. In question 9 we'll have some wording in there. In question 10 we won't bother. Okay, so Let's go budget, and let's go variance. Now in this question here, we're always going to have this thing of rounded to, so we're going to work out what it's going to be. And there, so variance percentage. And so we'll go materials. Budget's going to be 91,500. The actuals 93,440. And so our variance, oh sorry, our actual. So I suppose really the question, or the thing about the actual question here is it's just trying to see if you'll just nicely shortcut and not put your workings out like this in here. So take the smaller number from the bigger number, there's our variance, so that would drop into there. And then we're going to divide that variance. We're going to divide that variance by the budget to give us that one. And let's now get what we're going for, 2 decimal places, rounded to 2 decimal places, 2.12. Okay, so that's our first answer. Now let's do the next one, labour. So here's our budget, 115,350. Here's our actuals in here, 121,120. And here's where we're just trying to get this little, so we miss, the question sort of misses that one out, or you to try and see whether you will miss it out as well on your workings. And so the variance was the difference between the bigger and smaller number, and it's 5%. And then the production, it's in here, 65,100. That one there, and 66,300 is what it actually costed us. So the variance is 1,200 and 1.84, and okay, that's that. Right. Malibu Limited has a policy of identifying variances that exceed 6% of budget as a significance, and then reporting only those variances to the appropriate managers. Okay. So we're going to do that again, this exercise again, here. So we're going to just budget and our variance and the percentage, and then the significant. So we go 73,400 and 4820. Okay, so there's our variance. Let's put our variance percentage in. So what we're going for, percentage, like that. And so what we've got is, if it exceeds 6%, so it is that exceeds 6%, so that is significant. There. Okay, and then 10,05,430, and the variance is 5,940, and so we'll see what that's going to be. 5.63, so that will be not. And 81,400 and 51700. And so that one's going to be significant. Now, in reality, did anybody ever really do this, investigate variances like this? Absolutely not. This is the biggest variance here, and so it costs us more money, and so we're definitely looking at that. And so there will be a judgmental. Nobody. Well, I've just never seen anybody remotely do that. I think about sort of 26 years now. I've been knocking this out. So, in reality, so no, you would look at the biggest variance really, if it was over a particular amount. But there's nothing really to talk about between any of those ones, especially. But we'll just follow the equations we're supposed to. Right. Identify whether the following statements are true or false. The direct materials variance should be reported to the purchasing manager and production value. Right, okay, so what we've now got then here is we're going to sort of sit down and we're going to see who is relevant. Right, so we've got direct materials. So we've got materials. We've got a variance here, have we? and we're talking about purchasing and production. Right, okay. Let's imagine now a world where this is negative. So this is an adverse variance. We've lost some money and we want to sort out something in terms of performance of a particular manager. Who could actually have cost us this money? Well, it could be the purchase manager. They could have been really poor at purchasing, and so they could have bought this stuff at a more expensive amount. Now, our purchase manager will say that it was all about exchange rates or Brexit, and you would get exchange rates out and see whether they actually moved or not, or whether it's just that the purchase manager couldn't purchase to save their life. Alternatively, the production manager might be just not really on there and overseeing what's going on the workshop floor. Everybody might be wasting all of your product. Making it poorly or what have you. There might be poor training of staff, and so we've got a lot of wastage going on. So both of those two could be on the hook for this thing there. So that one would definitely be true, because those would be there. And when I say report to, it's not really report to like a, oh, would you mind awfully noting the variance. It's like, what's going on? Why is it that we have this this variance in here? Who's not doing their job properly if we've got an adverse variance, or alternatively if we've got a positive one, yeah, it's going really well, well done you. Because it's always good to motivate your staff as well and actually recognise good performance. But similarly, things going wrong, which is quite often what you're getting involved in as an accountant, who is it? Now, actually, in this one, later on in level 3, you're going to split this materials variance between cost variances and production variances, and we'll see exactly who it is between the two of them. The direct labour variance should be reported to the training manager. Right, okay. The direct labour variance should be reported to the training manager. In reality, no, probably not really. It's going to be the production manager who's going to be the direct labour variance. Now, actually, the training manager might be an interesting one, because it's not a great question, actually, this one, really. If we were really actually working in a firm and we were doing this, and the direct labour variance probably would be reported to the training manager, and they're not in terms of actually reporting to them, telling them about it, because it would inform our training schedule. But it's not, because the training manager in this one, it should be the production manager asking the training manager to sort out some training for their staff, or using it as an excuse that the training was given was really poor. Not a great question, that, because it actually could go either way. The production overhead variance should be reported to the training manager. Well, that's a nonsense answer. What on earth would the production overhead variance have in terms of the reason why there's no production overhead variance is at level 3, really, in terms of we've not produced as much as we wanted to, and so we haven't absorbed as many overheads as we wanted. Or alternatively, that actually this is a estates manager and their energy, let's say, bills have gone through the roof or what have you. So it's got nothing to do with a training manager. That would be more like the estates manager or the person who maintains the assembly line or something like that. The production overhead variance should be reported to the production manager. Yes, they are responsible for that. They might be responsible for the amount of energy that's, people aren't switching the lights off, or they've not properly maintained the assembly line or something like that. We've got more sort of costs coming in like that. There'll be a few other people that be involved. So let's be the person who renegotiates the rent of the building or whatever. But the production manager would be in there. If we had a few more like the estates manager in there or something like that, would have made it a bit more interesting. And so that's that. Right, question 10's done. That's the end of it all. So that was an Osborne books one. I thought task 7 was more reflective of an exam kind of thing, where we can see we're having a good test really of how neat you are or how organised you are in terms of your workings. Would you jump from this and start to try and add it up and do little scrappy workings, rather than laying out a nice table like that and ticking all of these things off, so that if you missed one, I think I sort of almost was half tempted to jump in there, the manufacturing cost being the direct cost plus the manufacturing overheads, without dropping in these extra ones that I sort of just scanned through and saw as I was going along the way to get to that. That way of just simply jumping straight to that, I think the trick here was these two very unusual ones being put in there, and if you didn't do it in a nice table, that would be wrong, and then all the other ones would fall apart as well. But then I thought that was very good reflective of exam technique and what would be required actually in the exam. The actual question itself wasn't that hard, but the way in which it was laid out was more designed to trick you, which is how the exams are within AAT. There's quite often a lot of exam technique required. So it's a bit different to the last BPP one. We had a nice high-low calculation within it, and we had this nice one which was sort of laid out in more challenging exam style, really. So I hope you enjoyed that. I'll see you in the next one. Bye bye.